Hi, welcome to the first video in the series. In this series, what I'm going to try and do is show you the efficacy of the four-phase framework. Now, most of you have come to this video series through the ebook. And as I explained in the ebook, one of the main reasons why retail traders fail, why there's so many retail traders failing, is because of the conflict in the methodology. Retail traders have been told that you're either a mechanical trader or a discretionary rule-based trader. There's a problem with both sides for the retail trader. For the mechanical, it is based on an assumption about the market conditions. And if the market conditions don't happen to match the assumptions of the mechanical system, then you will run into a series of consecutive losses. The retail trader finds it difficult to stick with the system even though it's within the tolerance window. For the discretionary rule-based trader, what happens is the retail trader creates a series of rules that are so complicated that they are very difficult to execute, if not impossible. What we did in the four-phase framework is combine the two. Rather than having separated the two elements, we combined them. What we said was, as far as the trend definition is concerned, what is the trend of the time frame, the trader's time frame, the time frame I'm trading, and is it likely to continue or change? That is discretionary. You use ideas, context, experience that you have to determine what is the trend, is it likely to continue or change? The answer to that question tells you whether you're going to be short or going to be long. Then, once you have that question answered, you shift into the mechanical phase, which is the execution phase: entry, initial stop, trade management, position sizing, reward to risk, and so on. In this video series, we're going to show you how I think, and hopefully it will help you achieve a measure of greater success in your trading. So let's begin. Okay, guys, so we're back. As I said, this is a video on the NASDAQ. So let's have a look at the trend of the time frame I'm trading. And the trend of the time frame I'm trading is the weekly trend, represented by the blue line on this chart, which is a 5-period daily swing, a 5-period barrel swing on a daily chart, which represents a weekly trend. The black line represents the quarterly trend, 73-period swing on a daily chart. I usually use 13-period swing on a weekly. The green line represents a 200-day swing that usually use a monthly chart, 12-period swing on a monthly chart. And the red line is the monthly swing, 18-period barrel swing on a daily chart represents the monthly trend. Now, first thing you're going to ask me is, where's the red line on this movement up? Well, it's below the black line. So right now, what we're saying is that the trend is up, the blue line trend is up. We're also seeing that the line direction of both the quarterly and the monthly is up. And in fact, the line direction is so strong in the quarterly that it's preventing the monthly from showing any swings. So that is positive. So at this point, what we're saying is the blue line is up. We're asking the question, is it likely to continue or change? And at this point, we're saying it is likely to continue moving up. That said, a couple of things we want to draw our attention to. First thing is, this point here is a previous high. Now, previous highs tend to provide strong resistance. So that is one negative aspect, because as we see, there are other negative aspects that suggested that this high here may be a stopping point. But let's go to the next chart. And in this chart, this one is just to show a monthly swing. You can see that the 12 monthly period is up and the trend is quite strongly up, obviously. Now, in this chart, all I want you to focus on are the red lines. What we're seeing is, as the market has been moving up, volume has been dropping, which is, for me, bearish. Okay, very important. Don't worry about the other words. This is my snapshot from my diaries of putting my action plans. We'll come back to this in a moment. Right now, all you want to focus on, as price actions moved up, volumes moved down, and that's bearish. Next thing, we see the same thing as far as the ranges are concerned. Started off with a 383 average true range. We're using average true ranges here. ATRs, then 239, and then in the last week it's dropped to 139, with one day on Wednesday showing 91.80. And on Thursday, even though it was 170, it was a neutral day. Market open and closed in the center of the range, which is, for me, neutral. So what we have in terms of volume and range is decreasing as the market's moving higher, which suggests bearishness for me. The final thing I look at is momentum. So we look at a 240-minute chart, and what you want to see is, as this top part here, that's your primary sell zone, that's where we expect the markets to come off, and that's the primary buy zone. That's where you expect the markets to turn up as the market's moving higher. However, each time the market makes a new high, if it doesn't hit the primary sell zone, come close to it, as we did, came close to it here, came close to it there, we certainly hit it there. But look at all of these. As the market's been moving higher, we have been unable to increase the momentum, and that is bearish. So momentum, volume, range, all bearish. So for me, I then had to formulate a plan coming into the non-farm payrolls. And the plan was a simple one. I said, I'm looking to sell after the figure, obviously. Now, ideally, the market before the non-farm payrolls moves above 97.56. That's up here, it moves above the high. And then after the non-farm payrolls, the market comes down and gives me an acceptance bar below 95.99. Acceptance bar means a bearish conviction bar. I'll have a hard stop above 97.57 or above the high of the day, whichever is the higher. My maximum low entry was 95.27. If the figure came out was so bearish the market exceeded that without giving me a chance to enter, I would not enter below 95.27. I would have to wait for retracement back to 95.27, because otherwise the risk reward was not adequate as far as I was concerned. Don't worry about the soft stop, something I'll explain perhaps in later videos. So what was the expectation for non-farm payrolls? Well, the expectation for non-farm payrolls was around 7.7 million loss of jobs, right? 7.7 million loss of jobs. The range was from 11 mil to 3.5 loss of jobs. So what had to happen for my market to tank? If I wanted to see the market move down strongly, what Pete Stettlemyer is my mentor, market profile man, and he used to have a thing called trend days, where the market moves in one direction with very little retracement and finishes at the lower or upper extremes. If it's a trend day down, it'll close within 20% of its lows. If it's a trend day up, it'll close within 20% of its highs. What does the market have to do to close, to have a trend day and close within 20% of its lows? Well, in my view, it had to show a number which was close to or exceeded 11 million loss of jobs. One thing that I always do, and I can't stress this enough, and if you take nothing else away from from this video, I've done a good job. Always, always take the opposite view from your bias. By that, I mean this. I'm biased to the short side going into non-farm payrolls. I've set out my plan as to what I'm going to do. Next question is, what has to happen for the market to go up? What has to happen for the market to form a trend day up? And for me, the answer was, well, it would have to give a figure below a loss of jobs of 3.5 mil. And what I decided on was, if it showed a job less than 500,000, preferably around 100,000 to zero loss, I was prepared to go long. And that would mean going long at the end of the first 30 minutes. So the figure comes out at 8:30, I'd go long at 9 o'clock. My stop would be below the low of that bar, 8:30 to 9, and I would be I did calculate what the range would be if such a number would come out. It would give me a rough idea of what the range would be if that number did come out around 100,000 to zero. I didn't expect it, but I do prepare for it. And as it turned out, that's what the market did. It came out with a job plus. We added, according to the Department of Stats, it came up with a plus 2.5 million jobs. So there's the bar, and that's about a 32-point range for that bar. I bought that on the close and exited where you see there at 60, make sure I made about 60, in this point would have made about, I think, 3160. About 40 points, I think, off the top of my head. It was about 1-to-1, a little bit better than 1-to-1. So that was a good result. And therefore, what the lesson I'm trying to drive home here in this video is, this is the way I think in terms of trend. Is it likely to continue or change? Then create a plan, and then look at the opposite side. Now, in closing, the question now becomes, can we expect this market to just explode to the upside? Because after all, the US market appears now, the economy appears now, as far as jobs are concerned, to be heading north. I subscribe to a service called Shadow Stats, excellent service, about 179 bucks a year, well worth the money. And notice what he says, that news was not particularly credible, and the blue and green lines give you the reasons why. What I'll do next week is go through these reasons. I'll also show you an indicator, which actually, one of the reasons I did not forget to look at the opposite side was this indicator suggested that I should be careful in joining a consensus. There was a chance, a good chance, that the market was going to give you a better figure than expected. I'll tell you about that indicator next week. And so if you have any questions, drop me a line. Hopefully you've learned something from this, and that will improve your trading. Thank you, guys.